Diego Sanchez, president of Housing Wire, and this is a special 20-minute talk. My guests today are Andrew Rodrigo Nigrinis and Todd Zywicki, authors of a recent study on the Fannie Mae title pilot. Andrew is an economist at Legal Economics LLC, while Todd is a professor of law at George Mason University. Andrew, so we have a foundation for this discussion. What is Fannie Mae's title insurance pilot program?
Well, I thought you were going to ask that to Todd because Todd is a former FTC man and he's grounded in the policies. But basically, in a nutshell, it's a new way of technology disrupting the market. It's a way for consumers, myself included actually, because I bought a house in September, to buy their title insurance through this program at a much reduced price, instead of having to use the traditional methods, which is often been fraught with legal problems such as RESPA violations, et cetera, like that, and also is highly restricted and regulated at the state level.
And Todd, I've been through the title process as well. Confusing, paper-driven process that takes 2-3 hours, maybe even longer, in a conference room with a bunch of people. Tell me a little bit more about what they're thinking in terms of the cost and time reduction in this pilot.
So one of the most important things to appreciate here, Diego, is this title pilot is quite limited and targeted a particular narrow problem. Title insurance itself and the closing process itself is a pain point for every American looking to buy a house. And housing affordability is a huge issue that both parties stressed during the election. And so people are looking for ways to bring down costs. So this was introduced by the Biden administration a couple of years ago this year, as a way of trying to bring down cost in the title, in the whole closing process. So now it could be as much as $4,000, $5,000 total to close, of which a substantial portion of that is title insurance. Often, second to the real estate broker's commission or things like that. So it's quite expensive, and it adds a lot of delay to the process. And this has been something that people focused on for a long time. Going back to when I was at the FTC during the Bush administration, for example, there was a proposal that would allow bundling of all closing costs, bundling or packaging, where right now everybody gets that horrible HUD-1, like you're going to go out and you're going to call around for the best price on pest inspections, right? Or call around for the best price for title insurance. And there's 50 different fees or whatever. And so one of the things we had proposed was to try to reduce costs, was to allow packaging of them, buy packages rather than all that disaggregated sort of stuff. And so as Andrew noted, this is a new way of doing title insurance. And it's targeted a particular area, which is this title pilot program only applies to very low risk refinance transactions. So it's refinance only, LTVs of 80% or less, where the risk is very, very small. It can still create a lot of delay. They still have a lot of a drawn out process where people go and they look at the title, they pull all the title and that sort of thing. And it's still quite expensive. And so the idea here is for these very low risk transactions, this would be a way of accelerating the process, getting it done, and recognizing that the market for title insurance, which I'm sure we'll talk about, just doesn't really work very well. Consumers don't shop for it well. You often get these proposals after you've, late in the process, where very few people are going to slow down the process of closing on a home just to try to save another $100 or $200 or $300 shopping around, trying to find a title insurance insurer in a market that's kind of very concentrated, and especially in local areas.
Yeah, I don't recall having a shopping process or even really knowing that the title process was coming when I bought my first home.
Right.
So Todd, sticking with you for a moment, what specifically did you and Andrew analyze in this study that you did?
So the concerns about the structure of the market have been around for a long time. And the problem, the underlying problem here is what economists refer to as a reverse competition market. Because consumers don't really have the incentive or the ability to shop around for different title insurance companies, the way this market works is it works by title insurance companies competing for referrals from realtors. And so that's where the market competition operates, not by the consumer, but by the realtor, which is not a very good way to run a market. There's only four big companies that really do this, that do for the whole company, whole country. But what you quickly discover is that in local markets where all this is done, there's only two or three companies. And so what you have is a highly concentrated market in a local area, which is by definition local. And we can talk about title plants and all that sort of stuff if we want, where the competitive structure doesn't work very well. And so there's long been a suspicion that title insurance prices are much higher than they should be. And so what we were trying to do here is look at, and I think what the Biden administration was doing was embracing this new structure of automatic underwriting, of using AI and big data, of basically scraping, collecting information out of local records, and coming up with sort of algorithmic predictions to try to figure out whether or not there's going to be a problem in a particular transaction. And again, very narrow, just refinances that are low risk. I mean, we're talking about when the person bought the home, presumably did a whole title search. They still own the home, they're refinancing, all that sort of thing. And so what we did here was try to come up with what is the direct value to consumers in terms of the lower prices offered by these guys. What would be the indirect value from if these automatic underwriting companies were to take, say, 10% of the market, how would that impact, basically what the market structure is today? How much would it be if they took some of the market? And what would be the competitive effects potentially if it caused the incumbents to reduce their cost by 10% in order to try to meet market competition, which is, of course, what you see in every market in which you see entry. So it's really a vehicle to try to figure out what would happen if we could use this process to introduce more competition into the system, not so much by consumers doing it directly, but by Fannie Mae essentially relaxing the rules and allowing this change in the underwriting process for these low risk refinance transactions.
Yeah, just digging in on the low risk there, it totally makes sense to me to focus on refinancing. Is there a maximum amount of time that that is in place in terms of how long it's been since the original mortgage? Because I can see, like, if it was just within the past 5 years, there's probably less risk and less change. But if the mortgage is 10 years old that you're refinancing, maybe there's a little bit more risk.
Not the way that it's currently structured. Sort of the public sort of description of the process is somewhat bare bones. So, for example, one of the most important things, and I want to make this very clear at the outset, Diego, is one of the most important things here is that the way this title pilot program is structured, in lieu of getting title insurance, what essentially would happen is there would be a payment to Fannie Mae to compensate Fannie Mae for the risk, right? And for example, it's not publicly disclosed how much basically the compensation has to be to Fannie Mae. And so one trade publication said it was $75, which is obviously a lot less than a full-blown title insurance process that the lender makes you buy. We estimated about, I think, $60 for our purposes. But why that's important is there are two things I think that Andrew and I really believe that are important to this is, number one, this does not inherently increase Fannie Mae's footprint over the housing market. It simply is a vehicle to try to reduce the cost of this one pain point that consumers have that slow down transactions and increase transactions, and to allow a different way of doing title insurance for these things. And second, our assumptions in the paper, our conclusions in the paper are dependent on the idea that whatever that risk premium would be, whatever that cost is that would be paid to Fannie Mae for taking this on, would fully compensate Fannie Mae over the long run for the potential of some of these mortgages going bad. So the idea here is Fannie Mae should remain in the same position with respect to this, but that we can deliver a lot more value at a lot more cost to consumers and a lot faster transaction in the way that this plays out on the through the closing process.
All right, I'm going to circle back on that in a moment, because that is one of the key objections from the big trade organization, the American Land Title Association. So we'll circle back on that in like 2 or 3 minutes. But Great. First, I don't want to bury the lead here. Andrew, what were the findings of this great study?
Well, essentially the findings are, well, depending on the interest rate you use, the lifetime of this program, if it continues indefinitely, could be in the hundreds of billions in terms of savings to the consumers. And like Todd said, it's based on 3 core assumptions. One is the direct savings for those who pick up the program. The second is the market, what I call the market effect, which is the beauty of competitive markets, is that you don't actually have to do anything. Just the threat that you might decide to change your provider will cause prices to come down. So the market effect is that the big incumbent firms will lower their prices, and we assume 10%. We had to do it by assumption rather than trying to do a whole demand and supply modeling, but I think is a pretty conservative estimate. And then the competitive effect is when the customers of the big 4 decide to switch. And essentially, we get really large numbers. For instance, it shouldn't be surprising to anyone who lives in Texas that big savings are in Texas, $1,600 roughly, which shouldn't be surprising given that Texas has very high regulated rates. The savings tend to be lower in states that are more competitive and allow the markets to function more effectively. Like Todd said, a lot of this comes down to market structure. If you believe that the markets are perfectly competitive and everything is efficient, then this program can never win because people won't switch, right? However, I don't know if anyone's ever been through the process, but I don't think anyone can claim that such a heavily regulated industry is competitive in getting efficient outcomes, as an economist would say. And hence, injecting competition into the process is very beneficial. And to be clear, we used historical data on losses, and we found that the loss rate was basically about $18 per policy. And we added administrative costs in there, and then we even tripled that as a stress factor. And the exact number we got was $56.88. Can't forget the 8 cents, right? But roughly $60, which is essentially what the trade publications, I believe they said 70 or 75, is basically in the ballpark. What's
As
interesting
reported
about
in Housing Wire.
Pardon?
As reported in Housing Wire.
Oh, hey, sorry about that. How rude of me. My apologies. But so I guess he did a very good job because that was spot on, right? But even if you bump that up a bit more, it's still massive savings. And the government's own estimates were about $500 to $1,500 in terms of savings for consumers. And we essentially found numbers. I mean, 1,600 because that was the upper end because every state is different. But essentially, we're right in that $500 to $1,500 range that they estimated, which is very reassuring. So, I mean, it'd be strange if we told people that they would be able to save all their money. That's obviously not true. But they are able to save a very large amount. And it's because technology can allow the GSEs to offer better prices. And when you really look at machine learning and artificial intelligence, I really dislike those two terms because essentially what they are is you're using statistical analysis to make better predictions. That's the core of machine learning. Whether it's your credit score or predicting what your Microsoft Word next word is going to be. That's probably a bad example because I find this almost always wrong on that one, the Microsoft Word. But that's the core essence of what's happening here. And what's driving the results in this paper are twofold. One is the ability of technology to lower costs, And two is the sensitivity of consumers to being able to find better deals. And that's going to come down to is how competitive is the market in this reverse competition? Can consumers move away and not be locked in? And offering them a better alternative will actually save a lot. And the more people switch, the more everyone gains.
Yeah, that makes a lot of logical sense. So, Todd, back to you, and circling back on that question I had about Alta. So, the American Land Title Association objects to the Fannie Mae pilot, believing that it will turn Fannie Mae into a title insurer. Do you have any concerns with the GSEs becoming title insurers?
Yeah, I mean, it doesn't strike me that that's an accurate description of what's going on here, right? In the sense that that they're basically being compensated for the risk that they're giving, right? The title insurance is still being done by the companies, and and under the current system. I guess they retain the risk, and Fannie Mae can put it back to them. But here, it's more like maybe it's more like a reinsurance company or something like that, right? Which is that so long as you get that risk premium right, it strikes me that the market should basically be indifferent to it. I mean, it seems to me to be somewhat of a semantic objection to say that they're becoming a title insurer here, to put it that way.
I would like to say that I'm sorry if you might interject here, but they are not offering, like the rate that's being offered includes both administrative fees and the stress factor. So it's not that the state is undercutting the private market. It's more along the lines of we have an oligopoly on our hands, and an oligopoly extracts profits. They actually have a fiduciary responsibility to their shareholders to try to do the best they can within the terms of the law. When you have an insurance market with oligopoly and inefficiency that results from oligopoly, sometimes self-insurance becomes an answer. So it's not that you're becoming an insurance company, but you have more than enough margin due to the oligopoly profits that you're able to offer a better deal. And if anything, wouldn't it be great if the big insurance companies responded with competition? So that could be investing in more efficient search processes. So maybe a combination of hand search that they do now with title plants and machine learning themselves. Maybe they can drop their margins. Maybe they can streamline the closing process so that the package goes down, even if they're able to maintain some margins on their particular piece of the package. I don't want to sit here and hypothesize what the solution will be because markets are very complex, and only central planners and big government bureaucrats believe they can predict the market perfectly. But I will go on a limb and say that the easiest solution is to compete.
Yeah, I completely agree. And actually, if you look at the big four title insurers, they have their primary title insurance business, but they've pushed into lots of different aspects of the housing ecosystem, and have built businesses in mortgage services, technology, real estate,
all the closing services, right?
Yeah. So okay. So that makes a lot of sense to me. How do you expand this pilot concept beyond refis? And I'll throw that question to both of you, whoever wants to jump in first.
Well, I just want to say that I think the upshot of the last conversation is that the Bush administration should have listened to Todd. But how to expand this into other markets? So it's always difficult to say that because every market is unique with its own unique challenges. But I would say that the commonality here is the use of technology to better make predictions and thus more efficiently predict probability of payment, of paying out, and to more efficiently price out insurance. Honestly, I think the best thing to do is just to do this one function and do it extremely well,
Mm.
and then worry about expanding elsewhere, because success will build on success. But I don't know, Todd. I don't want to speculate about other types of title insurance, but there definitely is a technological component that can be ported to other markets.
Yeah, I would say, how do we expand this to other markets? I would say cautiously. That what we're trying to do here that hasn't been done before with this is to really specifically, in a very specific case, try to get good estimates of what the benefits to consumers are, and does this actually increase risk? And what we found is, on this small set of cases, we found that there is no overall increase in risk in terms of loss rates. That this does at least as well as the traditional model, which also has become some extent uses artificial intelligence and the like, but also has human error built into it, right? Which seems to be some of the reason why things are missed there. But this is very specific. It's sort of a way of going at trying to find out what would be the risk of this and what are the benefits to consumers. And I think our conclusion here is that we believe that the Trump administration should continue this pilot, continue to study it, continue to do the kind of analysis that we do here, and see how it plays out, see how the market plays out, and then perhaps look at where it might be expanded more gradually to the next one. Right? Are there different refi transactions that this might apply to? Purchase money will obviously be more difficult, but coming up with good estimates of the numbers. And one of the things I think is inevitable that we say in the paper is that over time these models are going to just keep getting better and better, right? That's the thing with machine learning and artificial intelligence, is as these models get up and going and more data comes into the system, as they become more and more mature, they're going to get better and better at predicting risk, and they're going to get better and better at spotting patterns, and they're presumably going to become less and less expensive. And so once that technology is harnessed, it becomes easier to start imagining the potential for expanding beyond this. And I think this is the kind of model which is, even if the GSEs went away, even if Fannie Mae went away, as some people have talked about doing, I think this is going to persist. Right, this is where this market is headed, and it's going to expand more and more. And the logjam, as Andrew said, right now seems to be the competitive structure of the market, which seems to kind of lock in this traditional model and the reverse competition model of referrals. And so, to the extent that if all this does is crack open the market and make people more aware of this option, and perhaps allow the market to accelerate and to adopt this more, even if Fannie Mae doesn't do anything beyond this, right? To introduce this more into the market could be, in and of itself, one of the great virtues of this, if it spreads to more title insurance markets after that.
Well, you have a very powerful lender in United Wholesale Mortgage that seems pretty bought into the concept of lowering title costs. So we'll have to leave it there. Gentlemen, really appreciate you joining me on this special 20-minute talk today. Really interesting study, and really appreciate your time.
Thanks.
Thanks.